good afternoon, as it is at the moment. I'm delighted to be with you. I'm delighted that you're all here. We're here to talk about ESG, which is really one of the most important, big issues of our times. It's a fascinating topic in discussion. It's also very misunderstood. So I think it's very worthwhile to talk about it. And we have two absolutely fantastic guests. I'm really absolutely thrilled to have Shamila Subramani, who's the Chief Sustainability Officer for the JSE, and Gloisa Dlamini, who's the Chartered Development Financial Analyst and Head of ESG Analysis for Sanlam Corporate. I mean, it's fabulous to be talking about this issue now. Really, it is the culmination of a very long process of development of thought around how around corporate life and how it affects our ordinary lives. Maybe we should start with something really sort of fundamental. Lisa, maybe you can just describe what ESG is. Define it for us. Make it be very specific, because this is going to make a big difference in the road down the line.
Thank you, Tim, and thank you for having us. Just to correct you, I'm the head of distribution for Sanlam Corporate, but I'm also a certified ESG analyst, so I do provide input. So that is primarily my role. And when we speak about ESG, I think it tends to be very broad, because you need to really contextualize it to actually know what you're talking about. I think we can start with what we're referring to about E, S, and G. So when we speak about E, we speak about environmental aspects, which may or may not have a material financial impact on the performance of a company. And when we talk about S issues, we talk about social issues. These are then social aspects which, in the same vein, can have a financial impact on the performance of a company. And then when we speak about G, we speak about governance. And initially it was really referring to corporate governance, because it was really around making sure that corporations are governed well. But I think now we speak about governance, because it's not only private sector companies that need to be governed well, but also organizations in the public sector that need to be governed well. So it really is around the governance, of these organizations. So that's what we refer to about ESG, and it really goes back to there are various foundational ideals that inform why we speak about ESG in the financial context. Particular, it ranges from issues around corporate social responsibility, which around what is the responsibility of a corporation. But I think a good foundational concept and practice is really around sustainability and the idea of sustainable development. When you look at the underpinning pillars of sustainability, this is environmental pillars, social pillars, as well as environmental, economic sustainability pillars, and which all need to be underpinned by good governance. So that's why we speak about ESG, and there's a very good link to sustainability, the sustainability of these companies that we are planting our money in, and the sustainability of these companies that we are consuming their goods and services of. And so that is in a nutshell. I mean, it goes very deep, but I just wanted to then give it maybe in this way.
No, that's fine. That's very helpful. But the definition that I've got, which I quite liked, is that ESG is a collective term for a business's impact on the environment, society, as well as how robust and transparent its governance is in terms of company leadership, executive pay, audits, internal controls, and shareholder rights. Okay, so now that's a big mouthful, but it just gives you an idea. Shamila, maybe you can trace for us a little bit how we got here. This is really the culmination of a long-standing effort by society and corporations. Just take us through that quickly. Thank you.
Thanks, Tim, and thanks for having me today. It's such a pleasure to be here. Welcome and hi to everybody on the line. I see our numbers are ticking up. It's quite exciting to see the interest in the topic. And Tim, if I think about the definition and perhaps some of the genesis of sustainability and where we are now, it really emerged as a component of corporate ethics going back, and it was in response to the perceived public discontent over long-term damage that often has been caused by an entrenched focus on short-term profits. And we know many of our financial economic models are actually premised on that, right? The shorter term profit horizon. However, businesses need to exist into the longer term. And if we go back to the 1980s, probably 1987 more specifically, we're looking at the Brundtland, what we often refer to as the Brundtland definition, and sustainability means focusing on meeting the needs of the present without compromising the ability of future generations to meet their needs. And so the three pillars, which was great, so nicely articulated by Kalisa, is really what we then try to categorize those particular issues that we're trying to refer to within. And so we said it's the explicit focus on environmental and social issues. So if we go back and we think about it there, it's evolved in different ways. We've had corporate responsibility, we've had different terms that have come along. CSI has often been the place where, many companies have started their efforts in this regard. And we get to a point now where I think that what we're seeing is a far more mainstream uptake in the understanding that these issues matter and that businesses exist in a broader context of society and the environment. And that the context, particularly in relation to the environment, is really finite. And ultimately, our collective aim is to ensure adequate social foundations within this finite context of things like planetary boundaries. So how do we operate in a way that is profitable and equitable and that doesn't transgress those so that we ensure the long-term viability, sustainability of our operations and our practices? So that would be the additional layer that I think I would like to put on there. And so the measurement of those things is starting to become a lot better, should I say, because generally it's been, that's the kind of airy-fairy kind of, greenwashing. Is it? We're now starting to see financial impacts of a number of these issues manifesting.
Yeah, I mean, it's really the change of a global philosophy. I mean, it's fascinating to have seen it sort of develop in this way, because there was a time when the notion was that a company's primary duty was to generate profit for its shareholders. And it was sort of assumed, I think, that by focusing on that goal, that singular measurable goal, that it would really be that was sufficient, and I think gradually over the years we've begun to realize that it's not. And there's a lot of interest now, not only by companies in the ESG, but also by political groups. There's a civil society aspect to it. It's as you say, it is really going mainstream. It's really interesting. Can you describe how South Africa fits into all of this? I mean, I think in some ways South Africa's been a little bit ahead of the curve, or at least, in some senses there was more of an SRI aspect to South African business for time.
Yes. Yeah, so when you actually trace the development in the South African context, a lot of that was driven from the institutional investor space. So when you look at even how unions, you mentioned civil society, you also had unions back in the 80s, before we introduced Regulation 28 of the Pension Funds Act, wanting to have investments that have desirable environmental and social outcomes. The bigger aspect that what they wanted was a social outcome. And you can see that over the years, it then filtered into what we refer to as Regulation 28 of the Pension Funds Act, which effectively provides guidelines for these institutional investors around investing. And there was a principle that was introduced back in 2011 asking and encouraging institutional investors to consider these environmental, social, and governance factors in their management of the assets of the people. So it was basically saying to boards of trustees, you are managing assets and they're invested in this market, and you need to over and above just trying to get or maximizing a return, you must also think about the impact of the environment and the social aspects and governance aspects of these companies you're planting money into how they affect the portfolios that you're investing, but also the people who you are investing on behalf of. So we've seen that, and then we also then saw the Government Employees Pension Fund being one of the founding signatories of a good advocacy company or organization called the Principles for Responsible Investment Association. This was back in 2006, if I'm not mistaken.
Right.
And so you've seen that, and I think that was a good impetus. So you had our government employees pension fund also applying the similar pressure to the PIC, the Public Investment Corporation, to not only sign up but also incorporate environmental, social, and governance factors in how they invest. And then you also then had, a lot more support coming from fund managers who are now seeing that this is no longer something that is esoteric. This is something that is very fundamental to how you manage assets. And then you've seen a number of our South African fund managers going to sign up to be signatories, but also then start looking at how they adjust their investment processes and their approach to looking at companies that are listed on the JSE around a lens that also includes ESG issues. And you also have the other big institutions like your insurance companies, including Sanlam, becoming signatories because they realize that for them to be able to honor their liabilities, they also need to think about sustainability of the investment markets that they use to have, to grow the assets so that they can pay policies, etc. So you've seen that,
stock exchanges around the world. Just tell us a little bit about the JSE's, all of this from the JSE's perspective. What have you done? What are you trying to achieve from here on? What's the JSE's position?
Tim, the JSE's, I think, if I call it, measurable effort in relation to anything sustainability probably goes back to 2002, 2004. And we talked earlier on about SRI, and we were actually the first exchange in the world to have an ESG index. At that stage was our old SRI index that explicitly measured companies on the pillars on ESG and particular dimensions under that. And that goes back to, I think, 2004 was when that index actually came into place. The first exchange in the world to have an exchange-sponsored sustainability index, and definitely the first in an emerging market in its entirety. And so it really came about from saying the markets are going to have a role to play in the reallocation of capital, in the creation of awareness. And the JSE looked back and said, well, how can we create an enabling environment for better practices to grow? So practices in disclosure, but also practices from businesses, right? Because disclosure is one thing. What you really want is the change in behavior and understanding and thinking that happens behind that will ultimately generate good disclosures. So what are the levers that we could possibly pull in that regard? At the same time, context mattered. And it talks to the discussion we've had just now about within South Africa, these issues that, we talk about E issues and S issues have actually been front and center of what many businesses have faced going back many decades already. Think about the social context, think about issues in mining, think about some of the biggest, most prevalent sectors listed on the JSE, and immediately you get a view of what some of those things could be. And so why they're actually relevant to business. So the case for business has not been, difficult to find in some ways, but then how do you actually start bringing that into a capital market context? And so the JSE effectively considers maybe 4 levers that we use to try and say, how do we meet this vision of creating an enabling environment for better practices to grow? The first is regulation, and this is perhaps where your comment on the King Code comes in. So we're also a frontline regulator, and there was where you said to companies, okay, you need to act in line with that, and the JSE wanted governance codes that could be applied to companies. It comes from the thinking that says that good governance is the heart of good behavior. And so that's where it needs to happen. And so you need to think about how that governing body behaves and thinks. And that should filter through in how that company operates and how it considers its social value or its social license to operate within any context. And so the King Code at its heart, if you look from the beginning, I think it talks about the need to consider people, planet, and profit within the language of the codes, right? And that the fact that it's mandatory for companies to report in line with the codes on an apply and explain basis means that companies listed on the JSE need to think about those principles of the codes and the recommendations and apply those. It doesn't straitjacket you into these are the 30 ESG indicators you need to report on, but it says consider materiality. Your board needs to consider. That's the highest level of governance does that. And so that has been influential in practice and fed through the governance processes and has put us into a situation where, from a disclosure perspective, certainly South African listed companies are actually considered very highly in the world because the practices have been embedded to things like that. The second lever that we have is the products and services. So how do you enable the reallocation of capital? So move from governance and disclosure to fundamentally moving the money. And so things like ESG indices can help as benchmark tools. Things like green bonds and creating a segment where you can ring fence the capital raising to be able to look to more sustainable outcomes, which you can achieve through green bonds, social bonds, sustainability bonds, is another way. And so we explicitly built the platforms to do that. And then the last is engagement and advocacy, right? We're sitting at the intersection of issuers and investors firstly, but also a number of different other players within that market. And how do we help influence better practices? How do we learn from what's happening? And make sure also that we're helping to create a market that's resilient for the long term so that your and my pension actually has a longer term sustainable investment. And that we're doing that in a way that helps us attract foreign direct investment to our market and that helps our businesses change those practices. So ultimately, an entire market becomes more resilient.
All right, thanks very much. I just wanted to tell everybody who's part of this group that please do ask questions. We'll get to questions in a mo. There's a whole bunch happening already. I see a whole bunch of people are having problems, including me as it happens, with load shedding. So, but we do record these events, and we will put up a link to the completed event afterwards, and we'll here's a scam. It has been weaponized by phony social justice warriors, Musk wrote. This is on a tweet. He said that he made this comment after Tesla was removed from an ESG Standard & Poor's index, and he was outraged that Tesla was removed, and 6 oil companies were on the index. And he said a good ESG score amounts to a business's compliance with a leftist agenda. Right. What do you think? Polisa, maybe you should go first.
Hugh, it's a lot that's happening with that quote. And then part of me, I'm like, when I heard social justice warriors, I don't think that's an incorrect statement. It really is around social justice. And it's really different players in this financial markets, particularly, that are trying to then ensure that as a lever towards achieving social sustainability and environmental sustainability, we need to move towards social justice. And that's why we even talk about the just transition, because as we're wanting to transition to green economies, we need to actually think about this, how socially just can we do this? So I would agree with the social justice aspect, because it really is around getting that. But the
okay, so you're a social justice warrior. You've just admitted that here live.
Okay, I am at heart. Yes, I definitely am, and I definitely subscribe to social justice, because I think that's what it really does have an impact on the rands and cents of our economy. That if we don't have social justice, everything that we're trying to build will not necessarily be sustainable. But I think when he speaks to scam, and it really does sound like he's a very disgruntled company that was obviously removed from an index. But I think there needs to be an understanding that indexes are constructed by different index providers using different criteria and scoring metrics when they look at a company. So they would look at a company holistically, not just around a product. So yes, you can have a green product, but if you're from a social perspective, your labor practices are not sustainable, if maybe there's something not great in terms of your governance, as green as and clean tech as your technology is, if it's run within a company that may not meet the standards and the requirements of the index calculator, then it means that you are likely to be removed. So that's why you can still find oil companies coming in to say, they are included and they're not, because it goes beyond the product. So you might find that there are oil companies who are moving to greener ways of working, and they actually, from a overall scoring perspective on all three aspects, environmental, social, and governance factors, in aggregate, they score better. So I think there needs to be that understanding, and I don't think
it includes sustainability and governance as well. And it's actually on those sustainability and governance issues that that this particular index had a problem with Tesla, because they are producing cars that run off the electric cars. So you would expect them from an environmental point of view to get high marks, which they did. But the other aspects of it, they didn't. Shamila, you were talking about indexes a little bit, about the different indexes, and this is also relevant to this discussion. Maybe you should explain how we do it in South Africa, and maybe talk about Elon Musk's quote too, if you like. Are you also a social justice warrior?
Am I allowed to say it in public?
Of course. I'm a social justice warrior.
Of course. I think we have to be, because if I have to go back to roots and think about sustainability, it's context specific. I'm not sure how one exists in a country like ours and not understand that social justice is a fundamental sustainability issue. So that's absolutely. But going back to your question, Tim, on looking at the construction of indices, particularly sustainability indices, ESG indices, they will all be underpinned by a rating, an ESG rating. Now, there are multiple different ESG rating models that exist. Some of the names you'd be familiar with could be FTSE for Good, MSCI, Sustainalytics, a number of rating tools that are in existence. Now, the first thing I want to point to is the fact that a lot of the research has suggested there's very little correlation, right, between the scores of these different ratings. So if you could have one company that could score really well on one and really poorly on another, what that points to is that each one has a different theory of change possibly underpinning it, and a different way in which it's approaching it, which also points to the issue that there isn't a universal definition of sustainability or ESG, but we're trying to find convergence and common understanding around that. So each one will have a different theory of change, and hence your actual outcome and your rating as a company could be different across the board. And so different people are looking for different things. Now, on the construction of indices, that's perhaps the easier part, because the underlying rating model is really the thing that drives that. So what are you being assessed on? What is the particular element that particular rating tool is focusing on? Could it be, something that's fundamentally focused on climate change, and hence is really going to give a lot stronger weighting to your performance on your GHG reductions? Somebody else might say, we're actually trying to drive a different behavior, and so we perhaps might weight your social components, your remuneration components perhaps more strongly. And there could be variances within that for sectors. So if you take, for example, the FTSE for Good model that the JSE uses to underpin our sustainability indices, is one that differentiates between different sectors. So, for example, how a JSE Limited might be scored and what it's weighted heavily on particular elements within that. So that in a nutshell tells you a bit about how those ratings work and why it's important to understand what that ratings theory of change is. I'm calling it a theory of change, but each one is going to be something that is trying to drive. And so therefore, how your particular entity is viewed in the lens of that rating, and what then is emphasized or de-emphasized in that regard. And then based on that, an index is usually simply a threshold, that might say if an index rating is on a scale of 1 to 5, any company that scores 3 and above becomes, and 3 is considered good practice as an overall rating, then anybody 3 and above becomes a constituent of an index. And that index itself might then have different criteria like market capitalization, free float of the shares that underpin it, perhaps to make it more investable. So that's the interplay between the actual scoring of sustainability or ESG practices, and then how that feeds into the construction of an index.
Yeah. Can I add something there quickly?
Of course.
And another element, and I think sometimes it's not necessarily greatly appreciated, is that when these analyses happen, some analysts actually go further into the value chain that is that the company is in. So again, let's go back to Mr. Musk and say, okay, you're producing this Tesla car. But we
Right.
don't. When analysts go and analyze from an ESG perspective, they also analyze across the value chain, everything from how the inputs that you're using to produce that car are sourced, and how you get it to the market, right down to, you know, if I then take this car and now need to deliver it in the most remote of areas in the globe, then there's a carbon footprint that is likely to be there. So when you start then having that aggregate view, while you may have a good product, if from a value chain perspective, there's a lot of environmental issues just in that, it may actually make you score less. So that's what I think that we need to understand, because when we even speak about greenhouse emissions, we speak about, you know, scope 1, 2, and 3, because they speak to emissions that come from the value chain of producing your widget, you know. So I wanted to highlight that in terms of just thinking about, you know, when you start going granular, what are the factors that are considered?
And Tim, as a sustainable company, you know, so those are the things that feed into that, and are also part of why we're saying, you know, businesses up to now have usually we've been good at internalizing profit and externalizing cost to society and the environment, and often because we can't quantify some of those things, right? Until you started pricing for carbon emissions, did you really care that you were polluting, right? Until you started pricing for certain things. So that is part of what we need to consider when we think about sustainability. So even now, a fundamental financial economic decision that says, I'm going to invest in this particular thing because this is my projection, if the cost line of that projection is actually flawed in the first place, then the way that capital is allocated and what it's directed to is actually going to not be in line with what we need to achieve in terms of sustainable development. So once you start quantifying, pricing those, understanding impact, and not just thinking about how the outside impacts me, but how what I do fundamentally impacts society and the environment as well as an additional lens, some of those choices, economic choices, start to change.
Yeah, I mean, I think, you know, just to be fair to Mr. Musk, I mean, I think he is highlighting something of a weakness, or at least I think of it as a weakness, and that is really the broad scope of this. You know, it's and the very diverse nature of the levers here within this, because it's such an, you know, because you're looking at really the full spectrum, everything. You know, the how you treat your employees, what your free float is on the exchange, what your environmental, you know, policies are. That has advantages, of course, because you actually do want all of those things. You know, they all form part of the same idea. So you do, but measuring all of them and weighting each measurement of each individual item, it's quite a tricky job. Shamila, tell us about FTSE for Good, which is the one that you use. I mean, what do you see anomalies when you just instinctively look at the companies that are rated high on FTSE for Good compared to what you think of, what you think maybe the public perception of those companies would be? You know, I mean, I just to take one example. I mean, Sasol is part of FTSE for Good, isn't it? How does that happen?
So, Tim, again, remember I mentioned that one needs to understand what the underlying theory of change is and what that particular rating is trying to achieve. So, in line with the JSE's overall approach, which was to try and say, how do we improve disclosure practices in the market? Remember, we're looking at public entities. What we're really trying to drive is better information available in the public domain. And so what we're trying to drive is better disclosure. Now, we also need to say, let's look at the collective governance ecosystem. It's not just the exchange's responsibility. There's information that we try to get into the public domain. And then there are a number of different actors around there, you know, that would be different stakeholders. They could be shareholders, they could be activists, civil society, that look at that information and then engage with that company because they're all invested in some way or form in what that company does and how it behaves. So our drive is really to improve disclosure in the market. And so that rating, and for why a Sasol would be in that index, is because it's rated on what they disclose publicly on those dimensions, to be able to put that information publicly. But we're not taking a judgment call on whether what they're doing is good or bad, or whether a 10% reduction in emissions is good or bad, for example. What we want is the information to be there. And over time, you're also seeing those ratings themselves evolve towards more performance-oriented metrics from purely disclosure-based, right? So that is part of the evolution we need to be thinking about. And again, I mean, the fact that Sasol is there is more as a consequence that this particular rating tool is measuring disclosure practices. And I said that is actually feeding on a broader kind of an aim that the JSE has, which is to drive public disclosure, improve those disclosures in the marketplace, and allow a collective system to have access to that and be able to engage with the company as well. So that's part of it. And then, I mean, you can say Sasol, equally you could level that argument against the mining companies, right, that are listed on that index. But if you, for example, were an investor that had a particular, let's say, that says I want to go fossil free, well, then that's a different screening criteria that you use, right? Then you screen out those that are based on your particular perspective. Or I wanted to have very low environmental impact, then you might screen out others. So it does also talk to how the user is using that and what their intent is. And so there could be variations of that then happen. So the underlying data, for example, in our case, is available. So you as an investor, if you have a particular thread that you want to follow and an investment philosophy and strategy, you could take the underlying data and say, right, I can slice and dice this any way I want, and my subset is actually this is what I'm going to exclude, and therefore this is what I'm going to invest in. It doesn't mean that it's a one size fits all. And what we're doing, like I said, is perhaps taken more of the carrot approach, which is to say, let's drive better practices across the market, and then you can evolve your investment practices based on information that now becomes available.
Yes. I mean, the whole idea of this is to get companies to change. I mean, that's what we want. We want everybody in the pool, and we want them to be making measurable, steps forward. That's the maybe Xolisa, we've spoken a little bit about the negative side, I guess you could call it, of ESGs, but there's positive sides too. How would you, if you were pitching this to a company, what would you say to them? What would you how would it help them as opposed to helping society?
Oh, okay. So in that case, I think a useful way to look at it is really around even the evolution in thinking why we consider ESG aspects just in general. Because when you start looking in the financial sector, initially environmental, social, and governance aspects were viewed and assessed from a risk management paradigm, social and governance factors. So beyond looking at these as a risk mitigating approach, but I can actually start looking at what are the opportunities in society, in how the market is evolving, that are environmental, social, or governance based, that create opportunities for me to start increasing my profitability or increasing my sustainability in the company and my chances to be a going concern. And I think, when you look at the climate change, yes, there are lots of risks that come with climate change, but it's also created an opportunity for innovation around green technology and green and green energy. And, it's even kind of had a knock-on effect to why we even speak about green bonds today, to say, what are the aspects that are opportunities in this mega trend of climate change. And now you're starting to see a move in this evolution to say, yes, I can look at the risk and opportunity base, but I can also create positive outcome and impact through my company and what I do. And so now there's the impact aspect to say, yes, beyond the risk and opportunities, am I seeing opportunities that will help me be sustainable by making sure that I can demonstrate an impact of what I do? And I think that's what becomes important, the disclosure element that Shamila was speaking to, is because now you need to be able to be transparent and disclose the impact that you have, so that you as a company can get that goodwill. We used to talk about goodwill, and you want to retain customers and clients. So what makes you stand out from your competitors? Likely the kind of impact that you have beyond just the product that you are giving the consumer. So I think that if thinking about it in terms of that evolution, it makes it then a compelling thing to think about as a company, to say, beyond managing my risks and maybe identifying opportunities, what impacts am I having? And these are the discussions, for instance, we're having in our Sanlam corporate, to say, yes, we can do all the risk management and the social aspect, but what kind of impact are we creating through even our products? And are we actually, measuring that? And can we then take it out to the market to say, look, not only are you getting a financial product, but we are through the financial product, we are having impact as an organization on the sustainability of our country or and our economy.
Yeah, I mean, you spoke about the risk mitigation model. Kind of, you sort of like tossed it to one side, but I wouldn't toss it aside so fast. I mean, I think it's important for companies. It is a real benefit for companies to be able to anticipate risk. I mean, one of the things that you can see very clearly is, in the Slimes Dams disaster that we've just had. That's going to be a big cost for the company involved, and just by attending to more closely to some components of ESG, that could have been prevented, and that would have been materially important for the company. I think there are also there are also public relations issues involved, and investment relations issues involved. I certainly feel that I don't know how far this is extended into the market as a whole. Shamila, you could maybe talk to this point, but I do get a feeling that investors are they are making more active choices about who they're, not just from a regulatory point of view. It's not just because there's the pension fund has made a declaration on this, but even individuals within pension funds or even retail investors have started thinking a little bit more about where they want to invest and where they don't want to invest. Is that correct?
Yeah, Tim, so I think we're definitely seeing that awareness starting to creep in. I don't think South Africa is very far down the line in that regard, and really it's going to come down to the awareness of the investors, the trustee bodies, and all of that. There's a huge opportunity for education as to what this means and to why it matters in terms of the long-term resilience of those funds, right? And for ultimately what they pension to, but not just from the returns perspective, obviously, but it's the full spectrum of returns, because you don't want to be investing in something that ultimately is going to give you a poorer quality of life when you do retire. And whatever the case is, inequality in society that's precipitating behavior that you need to protect yourself against, where the water that you have to get is where you're going to pay exorbitant amount of money for, if you have it in the first place, and those sorts of things. So that is why this kind of thing, we need to actually think about what we're doing and how that has a long-term impact is important. And so the education then is very important, because we're still fundamentally driven on that. I mean, I would ask how many people open their pension fund statement and really think about what went into producing that result, and whether that thing that you're looking for, you want this money, but what did that money buy in terms of the quality that you're going to retire into, is some of where that education needs to come from. So I think that is where there's an opportunity now that's growing. However, the global statistics tell us a slightly different story. So if we look at the Global Sustainable Investment Alliance report, which comes out every 2 years, it tracks the amount of money that is going into anything labeled as responsible. And there are definite issues with what is labeled as responsible now. We've seen a huge change, labeling kind of uptick in anything ESG globally. But the flow of the money into funds has been massive globally, and we're seeing that happen. So there's no doubt that there is an increasing awareness and kind of, I suppose it's going to talk to an underlying want to invest more sustainably. But what we need to do is really re-examine what we call sustainable and is that fundamentally changing anything? Tied to that is the question about the perceptions around whether sustainable investing is equated to lower returns, because there's still quite a perception that some of that there might be a trade-off associated with some of that. And in some instances there is, but then it's going to be a deeper debate, not for today, as to the different investment strategies that are deployed and what is the outcome that you're trying to drive. So if we look at some of the indices currently that are existing globally, and we look at what we call ESG leaders indices, which usually takes the best scoring ESG companies, puts them in indices. The example for, like, you've got the MSCI ESG Emerging Market Leaders Index has outperformed the traditional benchmarks. Okay. And in the South African context, I mean, we've got the two JSE responsible investment indices. Our ESG, our top 30 responsible investment index, which is top 30 highest rated ESG companies on the JSE, or ESG rated companies, has outperformed the top 40 in the All Share Index pretty much since the inception of the RI top 30. So, those are some, but again, proceed with caution. Remember what we said about what is that underlying rating tool actually measuring, and then how many companies are actually being assessed. And the indices themselves perhaps exclude companies for obvious reasons around investability, and it starts limiting the universe that's looked at. In pretty much any market, you do have the challenge where a lot of the money is flowing into the top stocks, and then you have quite a large tail that doesn't necessarily have the same amount of investment or visibility in an investor's mind. So those are the things I think that will all be part of understanding how that money is flowing, what is happening, and where the markets are being used to try and drive, different practices and different behavior. So there's definitely a caution around that. And I certainly think the space is for investor education to a large extent. Yeah. And remember, that's not just about what you invest in on the market. That's also in how you behave as a consumer. And you're actually driving change through the awareness that you have as a consumer and the questions that you're asking of the products that you buy.
I mean, we have seen and there's also a question on this, and I think we should move into questions now too. The PR aspect of this is creating its own sort of potential problems. Maybe Xolisa, you can describe what happened with greenwashing, what greenwashing is, and what happened with Deutsche Bank, and what that says about the process.
Yeah, I think greenwashing is a very important aspect of. I think it's a risk that comes with the changing demands on investors and even the companies from an environmental, social, and governance factor perspective. And again, going back to disclosure, to say, companies are now expected to disclose more and be transparent with that disclosure. So yes, you can disclose and keep it to across any sustainability aspects that you report as a company. And I think it's quite risky in the sense that, it starts with an accusation. So it's not necessarily that you are greenwashing, but if there's a perception that you're greenwashing because perhaps you are very economical with what you are transparently disclosing, or you didn't actually articulate what it is that you're doing accurately, it's easy for anyone, civil society, individual, or even a regulator to say, what you represented in your annual report is not necessarily accurate because it doesn't look like that from an implementation or what we've observed from stakeholders, not just your internal customers or your shareholders. So when you then look at how that's filtering into fund management, it becomes very difficult because now you have fund managers who are saying we are engaging in responsible investment practices and we use various strategies, whether saying that they integrate these ESG factors into their portfolio construction and how they bring about and build this portfolio that you put your money in. And they then also say, maybe our approach excludes certain aspects, certain counters based on a social aspect or an environmental aspect. And then if you're found to not actually be aligned as a fund manager to what you have said and promised to your clients, which are the institutions that I mentioned earlier, then you run the risk of then being seen as greenwashing. And that's why I think when you look at what Deutsche Bank is, and from an asset management perspective, there's just all these kind of points that are an additional risk that are related to the data that you use, firstly to construct your reports, but also the accuracy of what you are reporting. And I mean, I think that in the listed space, you have requirements from the JSE, I think, where, things like reporting needs to be done, but I think auditing and those kind of hygiene factors are demanded to also partly protect these companies from greenwashing. But it becomes very tricky when you start going into maybe the unlisted space, your private equity, venture capital space, where there aren't really very stringent disclosure requirements, where you might actually not get around to disclosing properly and also be seen as greenwashing, because what you are seen and perceived to be doing and what you are seen and perceived to be reporting do not align. And I think that's when I look at that case, this is how I see it, and I just wanted to put it.
Yeah, no. I mean, it's obvious that if there is there's a danger that that organizations that do the rating, there'll be a kind of race to the bottom. So you could say, come and be rated by us. If so, does it cover certain regions or is it global? We've touched on both of these points, but Shamila, do you just want to quickly talk to that?
There isn't a universal ESG certification body, Tim. So there are different aspects within the different elements of sustainability that you will have certification bodies for. You might have a particular element that might say certify your claim of organic, and then there are standards and bodies that would help to give you the stamp to be able to say, okay, you've done the practices that are required in order to qualify for organic, as one of the examples. Or you could be something like says, you've logged sustainably, right? You cut down timber, but you're regrowing it, or you have a particularly sustainable source, and so your forestry practices are sustainable. So there could be elements within there that could be certified. But an overall rating, no. There are pieces of the puzzle, like if you wanted to have a bond, a green bond certified, for example, you could have a climate bond initiative certification that looks at what it is that bond is raising funds for. And again, in line with their theory of change, and in their case, their science-based standards, they would say, okay, what you've done is great, this particular technology or whatever it is or asset that you're going to use that money for, in terms of our standard actually qualifies as green, and therefore we'll call you a CBI accredited green bond. And,
right.
So those are, there are elements of it that exist, but a universal one, and you can understand already from seeing the variety of issues, right? It's not an easy thing to aim for.
No, for sure.
May I answer that quickly?
Sure.
Yeah, because I think, when you start looking at green bonds, for instance, that's why we have, I think in the South African context, we have now the green taxonomy that was published in April, which then helps to, in that process, make sure that a company, when they say they are, raising funds for a green project of sorts within their operations, then there's a very clear way for them to be able to assess whether what they're wanting to build is actually classified as a green project. And this taxonomy then becomes useful. So it doesn't become necessarily a standard that is imposed, but it's an enabler for kind of creating standard to say, here, what constitutes green? Because if you can then do that, and then you say, okay, I want to fund this project by raising a bond and maybe listing it on the JSE, then you have this guidance that helps you to say, this is what constitutes green projects. And for you to be able to list the green bonds, there are also very clear principles around listing these green bonds, including checking, and auditing that, the proceeds that are raised in the issue of the bond are actually used in the project itself. So over and above like normal standards, which there are many, they differ, there's also other processes that are in place that allow for that kind of the outcome that you want with a standard.
Yes. I mean, as Shamila said a couple of times, this is really about a theory of change. And it's important, I think, to record that these are that each one of these sort of different dimensions of ESG, has its own particular dynamics, but is also an ongoing process. The whole process of measuring these things it will gradually get more and more sophisticated as we go down the line.
Yeah.
Here's a very good question from Douglas Davis. He says recent PwC reports states that only 20% of South African CEOs indicated that their company has made some sort of carbon neutral commitment. Is this true? Are the JC guiding principles really working? And secondarily, what is or what should be the role of the investment industry? Wow, big question. Shamila, for a start, do you know whether that's true or not? Do you know that what the proportion of CEOs who've made a commitment to a carbon?
We don't track that ourselves, Tim, in terms of specifically a commitment to that. So we're going to have to trust PwC on their report there. But we don't track that ourselves. Carbon neutral. Usually it's going to be in the context of what the country is trying to achieve and then how you're supporting that, because you need the enabling environment to back up your claim. So those are some of the things that we need to think about. So we need to take the action. There's no doubt about that. I think it might be a bit binary by measuring that simply only by carbon neutral claims.
Yes.
But there's a lot of action that sometimes needs to happen before that. And before you commit, you usually need to think about it. So if you're like me, you generally don't want to say much until you actually have the backup and the action to prove it. And then I'll tell you once I've done it. And some of them might decide that they commit up front. And there's also now been a lot of criticism being labeled even at carbon neutral net zero claims, because they're kind of like they're aspirational, and a lot of the companies don't know exactly what they're going to do to get there. So it is a bit of caution. We absolutely need to commit. We know that achieving the Paris Agreement is in all our interests. In fact, many people have called the climate crisis our existential crisis, not even thinking about the biodiversity crisis that sits on the back of that as well, right?
Yes.
But so there's no doubt that we need to take action, but also, again, to be cautious that what you're putting out there is not a form of greenwashing, that you understand what it takes to be able to achieve that, and that you're able to get it.
I mean, it will differ from company to company, won't it? Because, there's some companies that are just never going to be carbon neutral. They could manufacture it in a way by supporting other carbon neutral, efforts. But in their own operations, I just don't see how a mining company could ever be absolutely carbon neutral. I don't know. I'd be interesting sort of theoretical discussion whether that's possible. But anyway, let's just push on quickly because we're running out of time now. Sorry, do you want to jump in?
No, I wanted to answer the second part of the question, because I think the question was, what is the role of the
the role of the investment industry?
Yeah, because I think from where I'm sitting, for Sanlam, for example, we have a fund management business where they are making the buy-sell decisions and doing the analysis on companies. So for them, their role in that particular part of ESG and sustainability is to then make sure that they are very well versed in assessing the risks and opportunities and the impact from an ESG perspective, but also translate that into not only the theories of change or the investment thesis, but also how they construct the portfolios, and then be able to report on that and try not to be inaccurate so that we're not getting greenwashing accusations. But you also have at the back of the investment managers, you have asset owners, the owners of the assets, whether they are individuals or retirement funds or insurance companies. And they also then need to provide guidance to the investment managers whom they delegated the investment management processes to, because they need to be then clear, especially when it comes to these carbon neutrality, because some funds may actually believe that, okay, maybe net zero is the advice that they give to a Sanlam umbrella fund, for instance, is enabling them to advance sustainability, but also be clear about what is it that the umbrella fund thinks, for instance, is an objective to be net zero or carbon or decarbonize or altogether. And then that will then trickle down to the investment managers. Yeah.
Tim, I need to make a quick punt there.
Okay,
the mandates are critically important, and Tolisa said that out beautifully. There's some work that was recently done for anybody who's looking at that and how to use that. That was done in conjunction with the International Corporate Governance Network and something that the JSE co-chairs, which is the Global Investors for Sustainable Development Alliance. In June, launched a model mandate that is basically something that anybody could use to how to consider explicitly, for example, the Sustainable Development Goals as and putting that into the mandates. And a lot of work went into that. So anyone's interested, please go look on the International Corporate Governance Network's website, the ICGN, and you'll find the model mandate that was issued in June that was launched. It is hugely useful in particularly dealing with that element that Tolisa just mentioned.
Right. Listen, we've just run out of time, which is terrible because I feel like I've been an awful host because there's 1,000 questions here that haven't been answered. But if you have asked a question, please don't despair. We will ask our guests if they can address them. There are really some very interesting questions here, I should tell you.
I'm seeing them too.
Good.
Maybe there needs to be continued.
No. Yes, no, absolutely. And Shamila, the point that you were making about the educating and developing an understanding of this is really well illustrated by the variety and diversity of inputs. So thank you very much for that. I also just want to really thank most sincerely ENSafrica for sponsoring this event. They are, as you know, one of South Africa's premier legal firms. They have been very active in the sphere, and it's and honestly, we're very appreciative of the fact that they've jumped in. Thanks, both of you. It's been a real pleasure. It's amazing how fast an hour can go when you're talking about something as interesting as this.
Yes. No, thank you for having us.
Absolutely. Thank you, Tim, and thanks for